Welcome to The Way of Wealth. I'm Corey.
And I'm Lily. Corey, I recently noticed something really interesting. There's an independent macro strategist named Tom Bradshaw, and his silver price prediction is very close to Macleod's, but they use completely different analytical methods.
Right. That's exactly what we're talking about today. You know what? When two independent analysts, one using fundamental analysis, one using technical analysis, arrive at highly consistent conclusions, that itself is a very strong signal. It's like two mountain climbers starting from different routes, but meeting at the same peak.
Macleod predicts silver can reach $300 in 2026. Bradshaw predicts $375 by 2028. The numbers differ by less than 25%, and the timing is only 2 years apart.
More importantly, Bradshaw isn't starting from supply-demand relationships or monetary theory at all. He's using a technical pattern that's been forming for 45 years, called a cup and handle pattern.
45 years? When did this pattern start forming?
Since 1980. Remember when silver hit $50 in 1980? The Hunt brothers tried to corner the silver market, and it triggered a collapse. That was silver's historical high. Then silver spent 30 years gradually falling and recovering, touching near $50 again in 2011. This forms a giant cup shape.
So both sides of the cup are around $50 highs?
Right. The cup bottom was roughly in the early 2000s, when silver dropped to $4 or $5. From $4 climbing back to $50, then from $50 falling and climbing back again, this giant U-shape is the cup. Then from 2011 to now, silver has been consolidating below the $50 ceiling. Recent years' highs have all been in the 40s. That's the handle portion.
Taking a full 45 years to complete one technical pattern must be very rare in financial markets.
Extremely rare. Normal cup and handle patterns might complete in a few months or a year or two. Silver spans nearly half a century. When this kind of ultra-long cycle pattern breaks out, based on technical analysis experience, it often triggers very dramatic price movements.
What happens after this pattern completes?
In technical analysis, the cup and handle is one of the strongest breakout signals. The traditional calculation method is this. You measure the cup's depth, the price difference from cup bottom to cup rim, then add that to the breakout point to get the theoretical target price. Silver's cup bottom is roughly $5. Cup rim is $50, so depth is $45. The basic target price is 50 plus 45 equals $95.
But Bradshaw predicts $375, which is much higher than 95.
Right. That's the result of his logarithmic scale calculation. In technical analysis, especially for long-cycle commodity trends, many analysts use logarithmic scales rather than linear scales. Because going from $5 to $50 is a tenfold increase. If the next wave is also tenfold, that's from $50 to $500. Bradshaw's 375 might be a relatively conservative estimate, considering actual markets won't follow mathematical formulas exactly.
This converges remarkably with Macleod's $300 derived from fundamental factors like supply-demand imbalance, industrial demand explosion, and China lifting suppression.
That's what I mean by double verification. One looks at chart patterns technically, one looks at supply-demand structure fundamentally. They're walking completely different paths, but both point in the same direction. This situation is very rare in investment analysis, and very significant.
What about Bradshaw's gold prediction?
He thinks gold could reach around $9,000 before 2028. This prediction is mainly based on three aspects: momentum cycles, historical breakout patterns, and changes in capital flows.
9,000! Sounds stunning. Gold is around 4,600 now. This requires doubling again.
Indeed, it sounds bold. But Bradshaw's logic is this. He observes that historically, whenever gold's annual gain exceeds 38%, a severe economic recession follows within the next few months. In 2025, gold rose 65%, far exceeding this warning threshold.
So he thinks recession is imminent?
Right. And not just an ordinary recession. Bradshaw has a warning indicator he calls the gold oil indicator, tracking inflation-adjusted price changes in gold and oil. When both commodities prices relative to their 12-month averages rise above certain threshold levels, this alarm sounds.
Has this indicator triggered before?
In the modern fiat currency era, this indicator has only triggered 3 times. First was 1974, right after the first oil crisis. The US economy fell into severe recession. The Dow plunged 45%. Inflation soared to 12%. Second was 1979. The Iranian Revolution triggered the second oil crisis. Unemployment and inflation spiked simultaneously, entering stagflation. Third was 2008. Just months before Lehman Brothers collapsed, the global financial crisis erupted.
Every time was a major economic disaster.
And every time, without exception. That's why Bradshaw takes this indicator so seriously. He says this indicator triggered again in March 2025.
It's been over a year now. Why haven't we seen obvious recession?
That's exactly what makes this indicator interesting. It's not saying the economy collapses immediately when the alarm sounds, but gives you an advance warning window. In 1974, the alarm sounded about 9 months before recession fully erupted. In 2008, about 6 months. It's been a year now based on historical experience. We might be right on the edge of recession.
If recession really comes, shouldn't gold and silver prices fall? I remember in 2008, gold and silver also fell initially, along with stocks.
You remember very clearly. This is the key part of Bradshaw's forecasting framework. He believes the whole process will unfold in 2 stages. Stage 1. Early recession. Liquidity tightens. Panic selling all assets gets sold for cash, including gold and silver.
How far will stage 1 fall?
Bradshaw predicts silver could retrace 40 to 45%, probably back to the $48 to $50 range. This price level is very interesting because it's exactly the historical highs from 1,980 and 2011. From a technical analysis perspective, these 2 highs form very strong support.
So if it really drops near $50, that's actually a buying opportunity?
That's what Bradshaw believes. Because next comes the critical stage 2. When governments see economic collapse, they'll definitely restart the printing presses. This isn't our speculation, it's what they've done every time they've faced crisis over the past 100 years. 2008 was like this. 2020 COVID was like this. Future recessions will be the same.
Financial addiction.
Right, they simply can't stop. Massive monetary flooding dilutes fiat currency purchasing power, and that's when physical assets explode. Bradshaw believes the rally starting from the $50 support level could directly push silver into the $300 to $400 range.
This logic really resembles what Macleod says. Macleod said the financial system's collapse will actually push gold and silver back to their monetary properties.
Right. That's why I keep emphasizing, the way of wealth is first, the way of wisdom. When you see 2 top analysts, one using Austrian School economic theory, talking about monetary essence, supply-demand structure, China's suppression. The other using a 45-year cup and handle pattern, gold oil indicator, momentum cycles, both arriving at the conclusion that gold and silver are about to surge. This consensus itself deserves our very serious attention.
Corey, Bradshaw also mentioned a concept called the stealth bear market. What does that mean?
This concept is very important because it reveals a wealth erosion process many people don't realize. Bradshaw observes the S&P 500 to gold price ratio, meaning how many units of the S&P 500 index 1 ounce of gold can buy. This ratio recently broke below its 10-year moving average.
What does this ratio represent?
It represents gold's purchasing power relative to stocks. If the ratio rises, stocks are appreciating relative to gold. If it falls, gold is appreciating relative to stocks. When this ratio breaks below the 10-year moving average, it means gold is entering a long-term phase of outperforming the stock market.
Has this happened before?
Since 1921, this has only happened 4 times. First was 1971. After the dollar decoupled from gold, gold launched a 10-year bull market. Second was 2002. After the dot-com bubble burst, gold climbed from over $200 all the way to $1,900 in 2011. Third was 2020, COVID outbreak. Fourth is now 2025.
What happened after each occurrence?
Each time initiated an era of gold long-term outperforming stocks. That means although stock nominal prices might still appear to be rising, if you measure in gold, your purchasing power is actually shrinking. That's the stealth bear market.
So on the surface, stocks look fine, but wealth is actually draining away?
Exactly. That's why we keep saying you can't use current social environment and mindset to approach future social conditions. When silver truly returns to its proper value, when gold truly reflects the depreciation degree of fiat currency, the entire financial system, tax system, banking operations will all change. At that point, you'll find people holding paper assets their nominal numbers might still be increasing, but actual purchasing power has drastically shrunk.
So what should we do now?
Bradshaw and Macleod's views are completely consistent on this point. Hold physical gold and silver. Not paper gold, not silver ETFs, not mining stocks, but truly tangible, hold in your hands physical metals.
If you can't touch it, you don't really own it.
Right. And both analysts believe there might be a significant pullback opportunity within the next 1 to 2 years. That would be a good time to add positions. But the key is you need basic allocation right now, because no one can precisely predict when the pullback will happen or how deep it will go.
The wealth emergency kit concept.
Right. Physical gold and silver are your wealth emergency kit. When the financial system has problems, when banks might limit withdrawals, when currency sharply depreciates, these real, tangible assets recognized for thousands of years are your insurance.
Corey, I have another question. Bradshaw's forecast timeline is 2028. Macleod's is 2026. If silver really reaches $300 in 2026, will it be even higher in 2028?
That's a very good question. Bradshaw believes from 2026 to 2028, gold and silver could continue rising. His $375 prediction can to some extent be seen as an extension of Macleod's $300 forecast. Think about it. If the financial system's problems aren't fundamentally resolved, if governments keep printing money, if US debt keeps expanding, why would silver stop at $300?
So if both are right, silver's rally could continue for several years?
Very possible. And remember, these are still relatively conservative technical targets. If what Macleod describes that kind of financial system reset, or what Bradshaw describes that kind of monetary confidence collapse actually happens, with silver returning to monetary properties, actual prices could be even higher than these predictions.
I remember Macleod mentioned a student who used logarithmic calculations and thought silver could reach $500.
Right. That calculation uses the same logic as Bradshaw's. From $5 to $50 is tenfold. The next tenfold is $500. Of course, this is an extreme scenario, but in a financial system collapse situation, it's not impossible.
It sounds like, from any analytical angle, physical gold and silver are must-have allocations.
Right. That's why today we specifically wanted to discuss this double verification concept. Investment decisions shouldn't rely on just one person's opinion or just one analytical method. You need to see whether multiple independent analyses all point in the same direction. When fundamental analysis and technical analysis both tell you the same thing, when Austrian School economists and technical analysts both reach the same conclusion, the signal's reliability significantly increases.
Like doctors diagnosing illness, if only one doctor says you have a problem, you might doubt it. But if several doctors from different specialties all say you have a problem, you definitely have to take it seriously.
Exactly right. And these doctors use completely different examination methods. One uses X-rays, one uses blood tests, one uses MRI, but all point to the same diagnosis. Can you not believe it then?
So if listeners want to start allocating now, what should they pay attention to?
I'll give 3 specific recommendations. First, definitely buy physical, not paper instruments. ETFs, mining stocks, these things might face trading suspensions or asset freezes during financial crisis. Physical gold and silver in your hands have no counterparty risk.
Second,
enter in batches. Don't throw all your capital in at once, because there could be short-term volatility, especially that pullback Bradshaw predicts. If you start allocating a portion now, then keep some capital to add during pullbacks. You can average your cost and won't miss the move.
what's the third recommendation?
Third, prepare mentally for long-term holding. This isn't short-term speculation, not buying today and selling tomorrow for a quick profit. This is wealth insurance. To counter potential financial system turbulence in the future, you need patience. You need to tolerate short-term price volatility. You need to believe in the long-term trend.
We plan, but heaven decides.
Right. What we can do is see the trend clearly, position ahead, then wait patiently. What Bradshaw and Macleod provide us are two different observation windows, one from the technical chart angle, one from the economic fundamentals angle, but they see the same future. The era of gold and silver is coming. Listeners of The Way of Wealth, remember to seize this historical turning point. Bye.
Bye.